Treasury investors are getting a bit of a reprieve this morning. Yields are down and prices are up slightly. But anyone who bought bonds over the past 2 months is sitting on losses. The big question is whether we're starting to see the start of a long-term sell-off or perhaps something a little more temporary. Here to help us answer the question is George Goncalves, head of interest rate strategy at Nomura, one of 18 primary dealers that trade directly with the Federal Reserve. George, you called it last time you were here. You advised people to get out of treasuries. You said yields were near the lows and there was hardly a chance of them going any lower. It was great advice. Things have backed up accordingly, perhaps, maybe not accordingly, but you called it. Where are we going from here?
Eric, thanks for having me on. I think, what we're witnessing right now is just this big cathartic move of over-positioning just because the Fed was buying treasuries. I mean, a lot of investors bought on the notion that, well, they can sell to the Fed later on. Here they are, as you mentioned, with severe losses on their hands. I think, we're into a very interesting time period. It's December. It's usually a turbulent period in the markets as people close down their books for the end of the year. I think that you can almost characterize it like this. The bond market can sometimes be clumsy. It's like a lot of elephants trying to jump through one window at the end of the year, which is this balance sheet window. Rates have backed up. I think we're at the higher end of the ranges. We could potentially rise higher from here, but we're almost at the end of the rate rise that we envision.
George, let's bring up a chart, and I want to have you talk about it for a moment. It shows the difference in the yield curve. Here it is. Maybe not the very best illustration, but what we're showing people here is the difference between the 2-year yield, which is on the left-hand side, and the 10-year yield. The white line is today. The yellow line below it is August the 26th. That's the day before Ben Bernanke spoke about quantitative easing at Jackson Hole. That's why we say bonds fall into a Jackson Hole here. What is that telling us? Are we going to see, even if 10-year yields remain stable or perhaps come back down a bit, are we going to see the yield curve continue to steepen, or is it likely that it'll more or less the pattern will hold static?
The Fed is on hold, keeping front-end rates anchored. That makes a lot of sense. But again, you have to take a step back and realize that a lot of investors bought on that notion of QE. QE worked. I mean, at that time period, people were worried about double dip. They're worried about deflation. The Fed has kind of cut that off at the pass. Where they've greased the wheels of recovery. The economy is, in our minds, continuing to grow. So I think that we should see higher rates and overall a steeper curve in the first start of the year, followed by a flattening.
Okay, so you fall into the camp, I take it then, the non-vigilante camp. You think that people are reacting more towards signs of growth than they are perhaps towards signs of a growing deficit thanks to the tax cut compromise?
I am. We've always factored in the Bush tax cuts being extended and these other tweaks on the margin obviously add to Treasury supply, but it's not what is driving the backup in rates. There was a large volume that took place between October and November based solely on that the Fed was going to be buying Treasuries. They bought at the lows in yields. People have been getting out of their week longs. Let's
talk about where things might move in the future. I want to bring up another chart. This shows the performance of the 10-year yield over the past 3 years. Let's see if it can come up, actually. What it shows us is that, here it is. You can see here that Treasury yields had a dramatic drop at the late 2008, beginning of 2009, the depths of the financial crisis. Then they backed up again into the sort of 4% neighborhood, and they plateaued until March of this year. They since dropped off. Now we're seeing them back up again. Where do you think, is that pattern going to be replicated?
To a certain extent, yes. But we won't get back, in my mind, to the same levels we had in 2009 because the recovery is not going to be as robust as people envisioned. In 2009, we're coming from the depths of the recession. The recovery move was huge. You had the stock market. You had all these other assets really improve. I think what we're going to see now is what I characterize different from 2010. In 2010, people were buying on strength. Next year, we're going to be selling on strength. So when bonds do rally, you take profits. You're going to have these ebbs and flows throughout the year where you don't want to buy just because the Fed is buying. Let them buy their treasuries. You buy something else.
George, one thing we have not seen play out is a rush into treasuries as concerns grow about the situation in Europe. We have seen that play out at least twice before.
That's right.
It's not happening now. Why?
Well, you look what's happening with the German bond market. Look, I'm not going to completely downplay our fiscal situation. We have to get that in order, and we do have a deficit ceiling issue that could come up in around February, March, where House Republicans might throw in a monkey wrench and not want to raise it for some time and play some political jawboning back and forth, which could be an issue for us as well. I mean, the issues in Germany and the potential of the contagion spreading to the core at the end of the day, the real core of the bond market is the U.S. bond market. So there is always a credit premium that I think could come down the road.
All right, we'll have to wait and see if it happens. George, we're always delighted to have you here in the Inside Track. George Goncalves of Nomura with some interest rate insights for us here on Bloomberg Television.